Welcome back to the Pro Ticker Podcast, your Wednesday morning edition covering major financial magazine headlines, everyone.
It is certainly a morning where the headlines feel heavier and, frankly, stranger than usual.
That is putting it mildly. I mean, usually when we talk about geopolitics on a Wednesday, we're discussing, a subtle shift in trade policy.
Maybe a central banker makes a vague comment.
Right, or a diplomatic summit where everyone shakes hands. But today we are talking about the President of the United States trying to buy an island.
The world's largest island.
And threatening tariffs on our oldest allies to get it, and the markets are just, well, they're taking a nosedive.
It is a sea of red out there.
Yeah.
And looking at the data, it's not just a standard correction. It feels structural. We're seeing volatility spikes we haven't seen in months.
Exactly. So our mission today is to unpack this massive risk-off day. We've got a stack of reports here. We're pulling directly from CNBC, Daily Open, Bloomberg, Reuters, and Yahoo Finance. And we need to look past just the scary red numbers on the screen and figure out if we're seeing a fundamental shift in how the world views American assets.
The Sell America trade.
That, a constitutional crisis brewing at the Federal Reserve, and a massive plot twist in the streaming wars with Netflix.
It's a heavy list, but, if you look closely at all these separate stories, they connect.
How so?
They all come back to one theme: uncertainty. Capital just hates uncertainty, and right now, the rules of the game seem to be changing by the hour.
Okay, so let's start with the catalyst, the Greenland crisis. I honestly can't believe I just said those words out loud.
It sounds like a joke, doesn't it?
Yeah.
But looking at the CNBC Daily Open report, this is very real. The S&P 500 and the NASDAQ just had their worst session since October.
And the driver is squarely this Greenland push.
It is President Trump's renewed and frankly very aggressive push to acquire Greenland.
But hold on, we've heard this before. He wanted to buy it in his first term. So why is the market reacting so violently this time? What's different today?
Because this time there are teeth involved. It's not just a, hey, is this for sale kind of thing. He's leveraging trade policy to force a real estate deal. According to Bloomberg, he is threatening a 10% tariff on goods from 8 European countries. And that starts February 1st.
8 countries, not just Denmark.
No, that's the key. This list includes the UK, France, Germany, Norway. He's basically dragging the core of the European economy into the whole thing.
And there's an escalation clause, isn't there? It doesn't just stay at 10%.
That's the kicker. That's why the algos are selling. He said if they don't cooperate with the purchase, that rate jumps to 25% by June.
25%. That is a massive tax on the European economy and, effectively a tax on us, on American consumers who buy those goods.
And February 1st is barely a week away. That timeline is just incredibly short for global supply chains to adjust. You can't just pivot billions of dollars of trade in 10 days.
It's impossible.
It is. And the reaction from Europe, it reflects that panic. You have the Greenlandic Prime Minister, Jens Frederik Nielsen, telling CNBC that they need to be prepared for everything.
Wow.
He even said that while it's unlikely, they aren't ruling out the possibility of U.S. military force.
Let's just pause on that for a second. We're talking about NATO allies discussing the potential for military action over a real estate deal. That rhetoric alone is terrifying for global stability.
It is. And the markets are pricing in that exact instability. Ursula von der Leyen from the European Commission is calling this a huge mistake, and they're already drafting a retaliation plan.
A trade bazooka, I think I read.
They're calling it a trade bazooka, about $108 billion in counter tariffs targeting U.S. goods. So we are staring down the barrel of a full-blown trade war with our closest allies.
Which brings us to this term I'm seeing everywhere today, the Sell America trade. It sounds dramatic, but what does it actually mean for you, the listener?
Well, it means investors are actively reducing their exposure to U.S. assets, stocks, bonds, the dollar, because they view the political risk as just too high.
So the U.S. is usually the safe haven, right? When the world gets scary, you buy dollars.
Exactly. But today, the U.S. is the scary part. And we actually have a concrete example of this happening. It's symbolic, but it's significant. There's a Danish pension fund.
Oh, this is the academic carpet.
That's the one. They announced they are selling off roughly $100 million in U.S. treasuries. Now, their investing chief was very specific. He cited poor U.S. government finances as the driver.
But come on, the timing can't be a coincidence. Surely the Greenland spat played a role.
Of course. He admitted the diplomatic rift didn't make the decision any harder. But I want to push back on what Treasury Secretary Scott Bessent said about this.
He's in Davos right now. What did he say?
He told reporters this sale was irrelevant. He basically said $100 million is a drop in the bucket.
Well, I mean, mathematically, he's not wrong, is he? The Treasury market is trillions of dollars.
Mathematically, no. But markets run on psychology, not just math. It's a signal. Pension funds are historically the most boring conservative investors on the planet.
They're the bedrock.
They are. And when a foreign institutional investor publicly says they are exiting U.S. government debt because they don't trust the finances or the stability, that is a vote of no confidence.
So the market isn't worried about the $100 million.
No. They're asking, okay, if one pension fund does it, who's next? That's the fear contagion.
And if you're selling America, you have to buy something else. Where's that money going?
It's going straight into the arms of the oldest safe haven in history. Gold.
I was looking at the data from CNBC, and the numbers are just staggering. Spot prices are sitting around, what, $4,861 an ounce?
Yeah.
I remember when everyone was shocked it hit $2,000 a few years ago. It feels like we skipped a few chapters.
It's been a parabolic rise. The inverse correlation is in full effect. As faith in the dollar wobbles, gold just skyrockets.
So the dollar's fiat. It relies on trust.
And gold is a hard asset. It relies on physics.
But is this just panic buying? Is this a bubble? Because usually when things go vertical like this, they crash just as hard.
The analysts don't seem to think so. The London Bullion Market Association sees it topping $5,000 this year, but the real jaw-dropper came from Julia Dua at ICBC Standard Bank.
What's her forecast?
She thinks it could go as high as $7,150.
$7,000 gold. That implies a completely different valuation of the U.S. dollar. That's almost double from where we are now.
Exactly. And they're arguing this is what's called a secular trade.
Okay, so define that for listeners who might not be day trading. What is a secular trade?
A secular trade is a long-term structural shift that lasts for years, regardless of short-term economic cycles. It's not a fad.
Okay.
The argument here is that central banks and private wealth firms are aggressively diversifying away from the dollar. It's what we were just talking about. This geopolitical tension makes the dollar less appealing as the sole reserve currency.
So if the U.S. is going to weaponize tariffs against allies, then holding U.S. debt becomes a liability.
Precisely. Goldman Sachs even called gold their highest conviction trade. So it's not just people buying jewelry. It's nations saying, we need insurance against American chaos.
And speaking of chaos, we have to pivot from the international stage back to Washington. Because if foreign investors are worried about stability, the story developing at the Federal Reserve is not going to comfort them.
You know, Yahoo Finance is covering this extensively, and it is a legal powder keg.
This story is wild. We have the Supreme Court hearing arguments today regarding President Trump attempting to fire a Federal Reserve governor.
Lisa Cook. Yes. Yeah. This is a critical moment for the whole concept of central bank independence. This case could redefine the relationship between the White House and our monetary supply.
And the White House is claiming this is about mortgage fraud allegations, but the Fed's argument is that's just a pretext.
Right. The argument is that this is actually about monetary policy. Trump has been demanding lower interest rates to boost the economy, and the Fed hasn't been moving fast enough for him.
So the fraud allegation is just a way to bypass the protections that keep the Fed independent.
That's what many legal scholars are saying. You can't fire them for policy disagreements, so you find or, invent a cause.
But it gets even messier. This isn't just a civil dispute anymore. I saw in the Yahoo report that the Department of Justice has issued grand jury subpoenas to the Fed.
Yes, and that is a massive escalation. They are criminally investigating Chair Jerome Powell.
Over what?
Over renovations to the Fed's headquarters.
Wait, renovations? They're using the DOJ to investigate office renovations. That feels targeted.
Well, in isolation, an investigation into spending is bureaucratic. But in this context, with a president trying to fire a governor and publicly pressuring the chair for lower rates, it looks like a coordinated pressure campaign.
A kind of thing you usually read about in emerging markets.
Exactly. Not in the world's leading economy. And Powell isn't hiding. In a very rare move, he's actually planning to attend the Supreme Court arguments in person.
So what are the stakes here for the listener? Why does it matter if Lisa Cook gets fired or Powell gets investigated over some wallpaper?
It matters because of four cause protections. The Fed was designed to be insulated from politics so it could make hard choices, like raising rates to fight inflation, even if those are unpopular.
But if the Supreme Court rules the president can fire a governor at will,
then the Fed loses its independence. Interest rates could become a political tool, moved up or down to help an election cycle rather than to manage the economy.
And if you're that Danish pension fund we talked about?
That is exactly the kind of instability that makes you sell U.S. treasuries. It all connects. Stability is the currency of trust, and right now we are burning through it.
And that stability isn't looking much better in the tech sector, specifically when it comes to Taiwan.
Right, the chip war. We've got new developments in that triangle between the U.S., China, and Taiwan.
The U.S. just cut a new trade deal with Taiwan.
A major piece of the puzzle. According to CNBC, the U.S. is reducing tariffs on Taiwanese goods to 15%. In exchange, Taiwan is committing to invest a massive $250 billion in the U.S.
$250 billion? In what?
Specifically in chip manufacturing, and AI Commerce Secretary Howard Lutnick was very clear. He wants to bring 40% of the semiconductor supply chain onto U.S. soil.
Onshoring, the most critical technology in the world, which sounds great for U.S. jobs and security, but Beijing must be furious.
Furious is the right word. We have quotes from Peng Qingjun, a spokesperson for China's Taiwan Affairs Office. He claims this deal will drain Taiwan's economy and hollow out their key industry.
Is there any truth to that, or is it just rhetoric?
There is an economic reality under the anger. China points out that labor costs for TSMC, the big chip maker to manufacture in the U.S., are double what they are in Taiwan.
So it's less efficient. It costs more to make the same chip.
Economically, yes.
Yes.
But strategically, it pulls Taiwan closer to the U.S. sphere of influence and hardens the tech supply chain against Chinese interference.
So we're trading economic efficiency for national security.
That's the trade-off. It's a tug of war for the most valuable technology on Earth, and it just adds another layer of risk for investors to worry about.
It does. But let's take a slight turn here. We've talked about governments, commodities. Let's talk about a company making a huge pivot amidst all this chaos, Netflix.
Ah, yes. The earnings report that has everyone scratching their heads.
Right. So I'm looking at the Reuters and Bloomberg numbers. Netflix beat earnings. Revenue was $12.05 billion. And yet the stock fell about 6%. What happened?
This is a classic sell the news event. And Bloomberg notes this has been a trend across the S&P 500. Even when companies beat profits, the market reaction is the worst we've seen since 2017.
So investors are just skittish about the future.
Incredibly skittish. They don't care about what you did last quarter. They are terrified of what you're doing next quarter. And what Netflix is doing next is, well, it's massive.
They're buying Warner Bros., Discovery's film and streaming assets.
This is a historic pivot. For over a decade, Netflix's mantra was, build, don't buy. Now they're putting an all-cash offer of $27.75 per share on the table. That's roughly $72 billion in equity value.
And they're in a bidding war, right? They're not the only ones.
They're fighting Paramount Skydance for it.
Yeah.
But Netflix seems determined. And the strategy is fascinating. They're basically admitting that buying a 100-year-old studio is faster than trying to build that prestige from scratch.
I guess you can't just build a Harry Potter or a Batman overnight. You can't buy history.
Exactly. The co-CEO, Greg Peters, specifically mentioned the HBO brand. He said it stands for Prestige TV.
Yeah.
They want that badge of quality. They want Game of Thrones. They want DC Comics. They want that entire library.
But this costs a lot of money.
It does, and that's the other reason stock dropped. To fund this, Netflix is pausing their share buybacks.
Ah, there it is. Investors love buybacks.
Of course. Netflix is saying, we aren't going to prop up the stock right now. We're going to spend that money on a massive integration. And investors look at that and they just see risk. They see debt.
It feels like the end of the streaming wars era and the beginning of the streaming monopoly era.
It's certainly consolidation on a massive scale. If Netflix lands this, they control the biggest engine of culture in the last century, Warner Bros., and the biggest of the current one, Netflix.
Wow. Now, before we wrap up, I want to bring this back down to the ground level. How do these big tariff fights hit your wallet?
We have two very different corporate stories today that illustrate this perfectly.
Yeah.
On one hand, you have Amazon.
Right. Andy Jassy gave an interview to CNBC.
And he was very honest. He admitted prices on Amazon are ticking up. He explained that they tried to pull forward inventory buy stuff early to beat the tariffs, but that supply ran out in the fall.
The buffer is gone.
It's gone. Now, any new inventory coming in is subject to these tariffs, and that cost is going to show up at your doorstep in a cardboard box as a higher price.
But then you have a company like Novartis.
Completely different. Their CEO says they are shielded because they produce in the U.S. for the U.S. They've localized their manufacturing. So it highlights the disparity. Companies that rely on global supply chains are going to pass costs on to you. Companies that localized are safe.
So globalization is becoming a liability.
And localization is becoming the ultimate asset.
So we've covered a lot. Greenland, gold, the Fed, chips, Netflix. If you had to distill this all down, What is the key takeaway?
One word: uncertainty. Markets hate not knowing the rules. And whether it's the sovereignty of Greenland, the independence of the Fed, or the future of the Harry Potter franchise, the common thread is that established norms are breaking down.
And that explains the Sell America trade. It's not about hating the U.S. economy. It's about finding safety when the world's biggest economy starts acting unpredictable.
Exactly. When the risk-free asset U.S. Treasury starts feeling risky, capital has to go somewhere else. Right now, it's going into gold.
So here's a thought to leave you with today. We talked about that Danish pension fund selling $100 million in treasuries and the Treasury Secretary calling it irrelevant. But at what dollar amount does it become relevant? Is it $1 billion? $10 billion? At what point does a signal become a siren? And on the entertainment side, if Netflix buys Warner Bros., does the streaming war officially end? Or has it just mutated into a new battle against monopoly regulators?
Those are the billion-dollar questions, aren't they? And we don't have the answers yet. But we know the market is going to be asking them for the next few weeks.
We certainly will be watching. We'll see you all tomorrow morning with new headlines from major financial magazines.